With global markets reeling from Donald Trump's newly announced Liberation Day tariffs, investors are beginning to ask the right question: where do you go when everything feels uncertain? In moments like this, one asset class quietly steps back into the spotlight. Gold. Now, I'm not talking about buying physical gold bars and burying them in your backyard. I'm talking about the gold sector, equities and ETFs that give you exposure to one of the most time-tested safe havens in financial history. Let's break down why this moment matters. Trump's tariffs aren't minor. We're talking about a 10% blanket tariff on all imported goods, with even higher penalties for goods from Europe, China, and other hostile trading partners. These tariffs have already sparked retaliatory threats, disrupted market confidence, and raised concerns around supply chain stability. For equity investors, it creates a risk-off environment where money tends to rotate out of high-growth or speculative sectors and into defensive plays. And few things are more defensive than gold. Historically, gold performs well when the following conditions align: rising inflation, geopolitical instability, weakness or uncertainty around the US dollar, global economic contraction or policy missteps. Right now, we're seeing shades of all four. And that's where gold equities come in. Unlike physical bullion, gold stocks and ETFs provide both leverage and liquidity. If gold rises by 5%, miners might rise 10 to 15% due to operating leverage. They are riskier, yes, but also more responsive to market dynamics. Let's take a look at some key players. US market, NYSE. Newmont Corporation, NEM, the world's largest gold miner. Diversified assets, long mine life, and a solid dividend history. Often seen as the blue chip of gold mining. Barrick Gold, another heavyweight with strategic global assets and a management team focused on efficiency and balance sheet discipline. Agnico Eagle Mines, AEM, is smaller than Newmont and Barrick, but praised for its high-grade assets and consistent production from Canada and Northern Europe. GDX ETF, the VanEck Gold Miners ETF, gives you broad exposure to major gold producers. Ideal for investors who want diversity without picking individual names. GDXJ ETF, the Junior Miners ETF. Higher risk, but also higher upside if smaller exploration companies and mid-tiers catch a bid. ASX market. Northern Star Resources, NST, one of Australia's premier producers. Solid margins, Australian dollar revenue, and a strong presence in Tier 1 mining jurisdictions. Evolution Mining, EVN, a mid-tier producer with a good balance of operational stability and upside potential. Regular dividend pair. Gold Road Resources, GOR, is smaller, but highly leveraged to gold prices due to its stake in the Gruyere joint venture. Potential upside in a rising gold market. BetaShares Global Gold Miners ETF, MNRS, an ASX-listed ETF with global exposure to major gold miners. So, is now the time to buy? The answer depends on your goal. If you want growth, gold miners can deliver that if gold breaks out. If you want protection, large-cap miners or ETFs offer a historically stable store of value. Right now, the gold sector isn't necessarily screaming higher, but it is quietly moving. And in a market dominated by noise, sometimes the best opportunities are the ones no one is shouting about. Gold isn't a trade. It's a counterweight. And gold stocks? They're worth watching. Especially when the world feels like it's slipping sideways. This isn't financial advice. But for anyone building a balanced portfolio in uncertain times, the gold sector deserves a serious second look.